Hey, it's Tom here and welcome back to the channel. So it's no secret that my favorite investor is Warren Buffett. I think I'm probably not alone in having Warren Buffett at the top of my list of favorite investors. And Warren Buffett has shared his wisdom around investing for decades at this point. And he has plenty of great lessons, and a few of them specifically relate to some of the advantages that you actually have as an individual investor as opposed to a professional investor. And I want to talk about one of those in this particular video, and that is around waiting for the perfect pitch and being comfortable basically with passing on companies and kind of letting pitches go by when they don't quite line up and meet all of your investment criteria. And I'm really keen to relate that back actually to one of the first companies that I ever talked about on the YouTube channel. I basically did an analysis video of this company and ended up not investing in it. And only a few months later, the stock was up 20%, then it was up 50%, then it was up 60 or 70%. And people were going back to this old video and commenting, I hope you changed your mind on this because it's gone up so much, and you're basically an idiot for not having invested in it. And I basically just want to share that story and kind of take you through my thought process around that and what's actually ended up happening with that company as we look at it again today. So that's the topic of today's video. Before we get into that one, we do have a sponsor for today's video, and today's sponsor is Hatch. Now, Hatch is the investment platform that I've personally been using for over 2 years at this point for me as a New Zealander, buying shares in large US companies. I basically do all of my US investing through Hatch, and it's a really simple, easy to use, and very low cost way to invest in the US. Before Hatch was around, I was using some of the big banks that were just charging astronomical fees, so I've saved really a lot of money through making investments in Hatch. And they've continued to kind of build up this community and also really improve the platform. And one of their most recent improvements is the launch of kids accounts. Now, individual investors, as I'll talk about in this video, have quite a few advantages over professional investors, and kids actually have one major advantage over people like me as mid-20-year-old individual investors. And that is basically their runway in terms of how long they've got to invest money. We know that the power of compounding works very, very well the longer you've got to invest. And of course, very young kids have as long as anyone to invest. So if you look back at the historic returns of US share markets over, say, the past 50 years, it's been around 10% per year. If we make the assumption that the markets are potentially going to do something similar moving forward. If you wanted $1 million nest egg by the time you're 65, if you're being born today, you really only need to invest about $2,000 in order to do that and never kind of contribute to that again. If you just reinvest your dividends, get that 10% compounded return per year, you'll get $1 million by the time you're 65. And that is the power of compounding and the power of having a long runway as an individual investor. So if you're interested in checking out Hatch Kids accounts or just getting set up with Hatch in general, you'll need to go to the link hatch.as/investingwithtom. If you go to that link and start a new Hatch account and deposit 100 New Zealand dollars into that account, you'll get a free $20 top up so that you can get started investing with a little bit more money. Okay, so Warren Buffett and the analogy of the perfect pitch. Now, the perfect pitch analogy actually comes from a guy by the name of Ted Williams. Now, Ted Williams, I must say I'm not a huge baseball follower, but as far as I understand it, Ted Williams has one of the highest, if not the highest, batting averages of all time in baseball. And one of the things that Ted Williams actually did was came out with this book around the science of hitting and how he basically chose which balls to swing at in order to have a really high success rate in terms of, hitting runs and hitting balls out of the park in baseball. And he basically looked at the strike zone in baseball and divided the strike zone up into, I believe, 77 individual baseballs that kind of fit into that area. And he figured out that if he was to hit a ball in each of those 77 different spots, what would his batting average be? And it was very clear that there were some areas within that strike zone where if he swung at them, his batting average was really, really good. And there were some areas where if he swung at those particular pitches, his batting average was very poor. And the way that Ted Williams approached baseball was basically he waited until he got a perfect pitch, until he got one right down the middle where he had a very high chance of connecting with that and hitting a good shot in baseball, and it allowed him to again have one of the greatest batting averages of all time. Now, the one downside for Ted Williams and for all baseball players is that they can only let so many pitches go by. So we all know that it's 3 strikes and you're out in baseball. So Ted Williams can maybe let 1 or 2 go by if they're not quite a perfect pitch. But at some point, he does have to swing at something, or else he's going to be out. He's going to be back in the batter's box, and he's going to have obviously lowered his batting average and not have got on first base or not have hit a home run or whatever. So that is where, if we apply this analogy to investing, individual investors actually have a massive advantage. So we can watch pitch after pitch go by in terms of different companies being presented to us in the stock market, and there are no called strikes. We don't have any sort of 3 strikes and you're out. We can have 100 different strikes go by. We can have hundreds or thousands of companies even pass by, and if we can pick up maybe 1 or 2 a year that are right down the middle for us, within our circle of competence, that have a moat, that have good management, and is available at a really attractive price, which offers a good margin of safety and an adequate return, as Ben Graham might describe it, then we're able to swing at those pitches, and it really doesn't matter that we've let another 1,000 go by beforehand. Now, there are plenty of companies that I have let go by over time, and there will be plenty more. I'm really only looking for maybe 1 to 2 new investments per year, taking on another one of the Warren Buffett analogies of having an investment punch card. That's a topic for another video, but I've let countless pitches go by, and one of the first sort of companies that I really let go by publicly and kind of talked about here on the YouTube channel was a business by the name of the A2 Milk Company. Now, the A2 Milk Company is one that's talked about all the time here in New Zealand and also in Australia. Up until recently, it had the largest market cap of any company in New Zealand, I believe, and it's been an absolute home run, to keep kind of the baseball terms going, in terms of investment returns over the last 10 years, or really since it's been a public company. It's returned thousands and thousands of % to early investors in the business. And when I first looked at A2 back in 2019 and made that first video, it actually had a lot of characteristics that would suggest it could be a pretty good pitch for me personally. Now, I grew up on a dairy farm, I studied a Bachelor of Agricultural Science, and I have a pretty strong background in agricultural food products. So in terms of circle of competence, the A2 Milk Company, there's really no issue at all there. That's squarely in the circle of competence for me. But there were a couple of issues that caused me to pass on A2 at the time. At the time, in 2019, they had about the most perfect financial statements you could ever see. So they had no debt, they had this phenomenal track record of just exponential growth year after year after year after year. Just the most perfect financials you will almost ever see. But there were a couple of key things that really caused me to pass on it and say, it looks like a reasonable pitch, but it's just not perfect, and it's not quite all the way there for me yet. And those things were twofold. So the first thing is I was skeptical about the actual A2 product. So A2 sort of market themselves as having this A2 beta-casein protein, which has many health advantages potentially over typical milk, which has a kind of combination of A1 and A2 proteins. And at the time, there was not actually that much evidence, as far as I could tell, really proving that it did have a lot of health advantages. Now, in the last 2 years, there's been more and more evidence coming out for the potential benefits of A2 milk, but it's hardly got sort of the full scientific community's consensus that really is the case. There's still more work to do there, and that was kind of earlier in its kind of stages of unfolding at the time in 2019. So that was the first thing, was just I was kind of skeptical around the product. But there's many advantages where I'm kind of skeptical about food products. So, I've talked about organic food, for example, in the past. I think is with many particular products, largely kind of marketing hype. There's certainly some examples of organic foods where the actual production system is very different from conventional farming. So organic chicken production, for example, is quite a different system to conventional chicken production. But if you were to look at, an organically farmed lamb, for example, here in New Zealand, there's really not that much difference in the sort of production system versus a conventionally farmed, sheep property. So when you get to the end product, there's really not all that much difference between the two. But nonetheless, products like A2 and organically branded products as well have had pretty good success in the marketplace, and they've had a good track record of charging premiums for their products. And the other thing with A2 is they were going through a bit of turbulence in terms of turnover of management, and finally the price just wasn't attractive to me at the time. I felt they were trading roughly at intrinsic value, which at the time I'd calculated at about $13 or $14 per share. I think the price was something like $13.50 or $14 around that time. So it didn't offer me the big margin of safety that I'm searching for, and I ended up passing on A2 Milk in 2019. And for quite some time after that video, I looked like a complete moron because the A2 Milk Company went from $13 or $14 a share to 15, into 16, into 17, into 18, and eventually all the way to about $20 per share or so over the next couple of years. And I don't want to name and shame or anything here, but if you were to go back and look at some of those, if you were to go back and look at that older video, you'll actually see kind of some history of comments. So you'll get the initial set of comments from when I posted the video. Then a few months later, you'll say, you know, you're a moron, basically. The stock's up 30% since you posted this. Then you'll get another one a few months later, or a year later, saying, you're more of a moron. I hope you changed your mind because the stock's now up 60%. And that really didn't faze me, but it's an interesting insight into what it could potentially be like to be a professional money manager. You know, one of the advantages of being an individual investor is I don't have to pay any attention to those types of comments. I can just continue to pass on stuff, and it really doesn't affect any other people. It's only my money that I'm investing. I'm not investing money for other individuals or anything like that professionally. But to go back to Buffett's analogy, you know, when you are managing money professional and you have this sort of institutional imperative to kind of be active and do stuff to, you know, earn your keep and earn the fees that you're charging, I think it's a good kind of insight into just the, you know, constant feedback that a lot of these professional money managers can be getting. And I imagine it's probably really difficult for some people in those positions to let these things go by and, you know, sit there and kind of look like an idiot from time to time, which is pretty much guaranteed to happen. Now, since making that video about A2 specifically back in 2019, A2 Milk has actually gone through some turbulence. So it did go up to about $20 per share, and then they had some fairly substantial issues. So they continued to have management turnover, and they've got a new CEO yet again. They also had really strong sales in early 2020, and a lot of that, which they probably didn't realize at the time, was people kind of stocking their pantries in the early stages of the pandemic. And, you know, they continued to produce really high amounts of product to prepare to sell because, you know, they thought, you know, we're growing really fast, sales are really great. And it turned out that, you know, people's pantries were now full and they were actually purchasing less than they had in early 2020. And for that reason, you had this big buildup of inventory from A2, which is now starting to age. And some of it is actually having to be destroyed in order for A2 to not have to pass on sort of aging product to their distributors and potentially damage the brand that way. And for that reason, A2 came out with, I think, about 4 earnings guidance downgrades in a row. I might be slightly off on that number, but I think it was around 4. And the price actually ended up going from $20 per share all the way down to a low of somewhere in the $5 per share range. And made a couple of videos on the channel kind of talking about my thoughts on that whole saga for A2. I actually ended up buying a little bit in about the $10 per share range. It continued downwards again, all the way down to about $5 per share, and I actually about doubled my position at about $6.40 per share. So I'm sort of down on my first allocation towards A2 and up a little bit now on that second allocation. So that's not a recommendation to buy or anything. I'm just kind of talking through the story here, but it just goes to show if you're patient, you know, as some of these events start to happen with companies and as prices do get to margin of safety levels, just because you passed on a pitch the first time around doesn't mean you won't get an opportunity to buy it, you know, a second time around later down the track. And A2 for me is by no means a large position. It was sort of like a rounding error in my portfolio at $10 per share. I exactly doubled the amount of cash that I put into that position when it was down at about $6.40. But double not much is still a small amount, so it's still not a huge chunk of the portfolio. But I thought it was interesting, and I thought the risk reward kind of was asymmetrical. I thought the potential risk of downside was much smaller than the potential opportunity for upside, and those are bets I like to make all day long. So again, don't take that as a stock tip, but that's kind of how I was thinking through it at the time. So there you have it. That is one of my favorite Warren Buffett analogies around waiting for a perfect pitch and letting investment idea and pitch after pitch go by until something is squarely in your circle of competence. And hopefully that kind of personal story around A2 is a good example of how that might look. Now, one of the key advantages, like I say, of being an individual investor is you really don't have a lot of outside pressure, and you can just stay in your lane, focus on stuff that you understand, and really not get caught up in the short-term fluctuations of the market, or you're not forced to chase hot stocks like a lot of institutional money managers often are. So do hope you enjoyed the video. Again, if you're interested in the Hatch offer, you'll need to go to the link hatch.as/investingwithtom. But that's it from me for this video, and I'll see you in the next one. Cheers.